As far as India is concerned and our love for SIPs, which has been growing month on month, we are seeing those numbers go up. But now it seems that SIP stoppage is actually happening too in these market conditions. The stoppage ratio in SIPs, and this is the ratio that relates the number of closed accounts under SIP of mutual fund houses to the new account openings, that ratio has shot up and it's now at a 27-month high of 0.68. In the month of February. This is the number that we're looking at for that month, 1 month of February. It comes in comparison with the long-term average of 0.51. And this is the data that we've got from AMFI, the Association of Mutual Funds in India. It also shows that investors are now turning cautious. And this, of course, is understandable. Reducing equity returns over the past 12 months could be one of the reasons. And also, returns of debt instruments, they've turned that much more attractive. Rising interest rates in the economy could be a prime reason why many investors are deciding that they don't want to continue with their SIPs. The average portfolio value of SIP account holders has actually dropped by as much as 11% to 1.1 lakh rupees. And this again, we're talking about the month of February this year. And this is also coming down from the peak value of 1.2 lakh rupees that was reported in August in 2021. Let's get perspective on this kind of stoppage when it comes to SIPs, because they were the flavor of the season and now the tide seems to be shifting. But how much? And does it even make prudent sense to go down that route of stopping SIPs? Lakshmi Iyer is joining us. She is CEO at Kotak Investment Advisors. And Misbah is also with us. Misbah is CEO at NJ Wealth. Great to have you both ladies. Lakshmi, let me ask you first. We are seeing this drop in SIP inflows in February, but the fact is that it's still steady. It's above the 13,000 crore mark for the fifth straight month now. The question is, will it trend downwards from here, considering all the volatility that surrounds us, amidst all the uncertainties that are emerging from the global financial stress? What are we expecting next?
Hi, Vikram. Good evening. So yes, your observation on all the points that you just mentioned are pretty bang on. But you must also note that the incremental net sales in the mutual fund industry, and of course, this includes the lump sum plus the SIPs, that number is growing over the last maybe 3, 4, 5 months. And that is clearly telling you that while the recency bias is playing on the investors' minds in terms of returns looking maybe flattish, in certain segments negative for the last 12 to 15 months, the fact remains that with every price point correction, we are seeing more monies also come into this asset class called equities. So my sense is therefore that if one were not to get too perturbed by the near-term trend, it looks like, with a correction price point, you will see more monies coming into the, the fray of equities rather than, lock, stock and barrel exit.
That's a fair point. Misbah, do come in. Do tell us, what's the strategy that you're spotting among mutual funds? I've been reading reports that mutual funds are also holding their cash positions amidst expectations of a correction in the markets. If that is the case, then why shouldn't investors actually take their cue and look elsewhere to park their money?
Very good evening, Vikram. Actually, the point is what you say that on the SIP thing, which I just wanted to add a few points. I'm not sure about or neither I track the cash holding position of a mutual fund. But from a distribution standpoint of and from an investor standpoint of view, I can only tell an investor, A is as an SIP investor, I don't think so. They should be, tracking the market. Neither they should be, really be worried about the current portfolio value of their SIPs, which is there for 1 year and 2 years. SIP is prima facie meant for long term, and longer the tenor is better. By simple, I'll just put some few examples is that if I do an SIP for 10 years, and an SIP of 10,000 rupees and a return of 12%, an investment of 12 lakh becomes nearly 23 lakhs, which is nearly 2 times the investment value. For 20 years, 24 lakhs becomes 92 lakhs, which is nearly 4 times the value. And for 30 years, 36 lakhs of investment becomes 3 crore 10 lakhs, which is nearly 10 times the value of investment. So my only point is that, as an SIP investor, we all tell only one thing to the investor is that please don't track the markets. Don't track what mutual funds are doing.
Yes.
Don't track the investment values, whatever returns that they have, and be disciplined with their long-term investment.
No, those are absolutely fair points. Lakshmi, as much as investors are advised to stay invested, keep the SIPs going regardless of where the markets are, even if they hit a rocky terrain. I'm just wondering, is it normal for people to stop their SIPs when they see asset classes out there that do better than their mutual fund portfolio? Isn't it normal for them to look elsewhere when you're seeing higher rewards?
Vikram, that's a very natural or an instinctive reaction, I would say. So if I'll give you a classic example. I'm an SIP investor, and assuming I put, money today, and I'm looking at my 1-year return, SIP return in, say, Nifty, it would be flattish, maybe 1-3%. And if the same portfolio I would have seen 1 year back, that return would have been maybe 7-8%. Likewise, if I would have put my money in, say, a small cap, a fund or an index, the return today, 1-year SIP returns are negative, maybe 3.5%. And exactly the same thing a year back, if I would have seen for the same period, it would have been close to 9%. So, the more you are seeing these numbers, it's instinctive to react, but that's not the right way to do. Because even today, if you look at the 3-year returns, has each of these categories, whether it's the large cap or the mid cap, has it visibly beaten inflation? The answer is yes. And that includes the 1 year of flat or negative returns. So I think clearly you have to think long term. You cannot be instinctive. Do you see the value of your house today and rush to sell or buy? The answer is no. Whether it's bought for investment or you're staying. So why treat something just because you can see the returns so regularly? Why do you have a differential treatment?
These are fair points. Misbah, I'm just going to play the devil's advocate because right now I want to ask you yourself how attractive bank deposit rates are looking. Are they worthy contenders to mutual funds when it comes to investment spreads?
And, the very similar answer which Lakshmi also gave. The point is that it is very natural instinct for an investor to hunt for where the returns are in the near term. So they tend to forget. So people do say the current scenario, say today gold is going good, people tend to attract themselves to gold. If the FD is attractive today, they tend to attract towards FD because they don't see the last 1 year return of equity to or the SIP to be good. That's what exactly I wanted to actually tell in that in an SIP, actually I always believe that it's a very systematic way of investing for a long period of time. And when you are investing systematically over a longer period of time, in those periods actually when the returns are bad or say subdued returns, say as Lakshmi has said that it is say flattish return or in certain cases is a negative return, it can only happen if the markets have corrected from the top. So when things have corrected from the top and have gone down, which is the current scenario, meaning that you are buying something at a discount, right? So something which is available at a discount, and investment is the only thing which people don't like to buy at a discount. Rest
Right.
everything they like to buy it at a discount.
Right.
So as an SIP investor, if the things are going down and if I'm getting the market at a cheaper value, I will be the most happiest person if my returns for next 2-3 years are also down, because it gives me a time to accumulate the units or the market at a cheaper value, which ultimately gets me the best of the benefit in the long term. So
Right.
so I seriously feel that I don't think so.
Yes.
And that's where I think so the role of a distributor or probably a mutual fund distributor comes in,
Sure.
and that's what we try to do.
Well, both our guests are in sync about stopping SIP is not a great idea. Don't move with the markets. Don't watch the markets. Don't time the markets. You cannot do that with your mutual fund investments, and you cannot stop your SIPs. Both seem to be saying that. Lakshmi, in that case, what should be the ideal strategy? Because you do want to hedge your risk. You want to get your split between debt and equity right, especially when interest rates are rising. What's the correct way of doing it?
No, I think once you have created your own Lakshman Rekha, Vikram, and when I say Lakshman Rekha, I'm talking about your contours of asset allocation. Please stick to it. Come what may, don't deviate from that. There might be some course corrections which are required. For example, if you are a 60-40 portfolio, equity versus debt, and because of the market movements, if your equity is right now at, say, 58%, please go ahead and plow in that 2%. I think that's extremely important, and that I think is responsible for more than 90% of the returns. If you are able to assess your risk and create an asset allocation, so I think that is the message in this market. And within the fixed income also, I had mentioned earlier in your show, if you have scan the environment properly, and there is, we are nearing the peak of interest rates, there is a case to enhance a little bit duration into your fixed income portfolio. But these are asset allocations and asset classes which will clearly coexist even in the current market ecosystem.